Converting assets to expenses. This segment's learning objective is to prepare adjusting entries to convert assets to expenses. When an expenditure is made that will benefit more than one accounting period, an asset account is debited and cash is credited. The asset account is used to defer or postpone expense recognition until a later date. At the end of each period benefiting from this expenditure, an adjusting entry is made to transfer an appropriate amount from the asset account to an expense account. This adjustment reflects the fact that part of the asset's cost has been matched against revenue in the measurement of income for the current period. When an adjusting entry is used to convert an asset to expense, a transaction took place in a prior period that involved the advance payment of an expense. Three common examples of adjusting entries to convert assets to expenses are the recognition of depreciation expense on plant assets, the using up of office supplies during the period, and the expiration of prepaid insurance. The adjusting entry is made at the end of the current period to recognize the converting of the prepaid asset into an expense. The asset account is reduced and the expense account is increased. Assume that on March 1st, Overnight purchased for $18,000 a one-year insurance policy providing comprehensive liability insurance and insurance against fire and damage to customers' vehicles while in Overnight's facilities. Therefore, 1/12 of this cost, or $1,500, is recognized as insurance expense every month. Here is the entry made by Overnight on March 1st to record the purchase of the policy. A debit or increase is made to the asset unexpired insurance, and a credit or decrease is made to the asset account cash for $18,000. Initially, costs that benefit more than one accounting period are recorded as assets. At the end of March, Overnight is going to prepare its financial statements. The costs are expensed as they are used to generate revenue. The proper adjusting entry is to debit or increase the expense account insurance expense, and to credit or decrease the asset account unexpired insurance for $1,500. Overnight will make this adjusting entry at the end of each month. After posting the adjusting entry to the general ledger accounts, it's clear that the asset unexpired insurance has been partially converted into the expense account insurance expense. Both the asset account and the expense account are now carried at their proper balances. Car owners typically pay insurance premiums 6 months in advance. Assume that you recently paid your 6-month premium of $600 on February 1st for coverage through July 31st. On March 31st, you decide to switch insurance companies. You call your existing agent and ask that your policy be canceled. Are you entitled to a refund? If so, why, and how much will it be? Depreciation is the systematic and rational allocation of the cost of a depreciable asset to expense over the asset's useful life. There are many methods of depreciation. The straight-line method of depreciation will be examined in this session. As a depreciable asset is used to produce revenue, the asset loses some of its utility and part of the asset is consumed. At the end of the accounting period, the expense relating to the consumption of the depreciable asset must be recorded. On January 22nd, Overnight purchased a building with a useful life of 240 months, or 20 years. The building cost $36,000. Overnight uses the straight-line method of depreciation and records depreciation expense monthly. Depreciation expense is equal to the cost less any anticipated salvage value divided by the estimated useful life. So, Overnight should record depreciation expense of $150 per month. Let's look at the adjusting entry required. How long does a building last? For purposes of computing depreciation expense, most companies estimate about 30 or 40 years. Yet the Empire State Building was built in 1931, and it's not likely to be torn down anytime soon. As you might guess, it often is difficult to estimate in advance just how long depreciable assets may remain in use. The adjusting journal entry required on December 31st is to debit or increase depreciation expense building and credit or increase the account accumulated depreciation building. We will assume that Overnight did not record any depreciation expense in January because it operated for only a small part of the month. Therefore, at the end of February, 1 month's depreciation or $150 would be recorded. The account accumulated depreciation building is a contra asset account. A contra account is a reduction in an associated account. In this case, accumulated depreciation will be shown on the balance sheet as a reduction in the building account. Remember that Overnight purchased tools and equipment costing $12,000. The tools and equipment have an estimated useful life of 5 years or 60 months. The proper adjusting entry is to debit depreciation expense tools and equipment for $200 and credit accumulated depreciation tools and equipment for the same amount. The accumulated depreciation account will appear on the balance sheet as a reduction in the tools and equipment account. This slide shows how Overnight shows its building and tools and equipment on the assets section of the balance sheet at December 31st, 2018. Notice that the contra accounts are subtracted from the related asset account. The cost of an asset less the accumulated depreciation is equal to book value of that asset. Book value is not intended to represent an asset's current market value. Total accumulated depreciation for 2018 is calculated by multiplying the monthly depreciation expense by 11 months.